Ken Griffin is one of the most hated men on the internet. If you spend any time on Reddit, you've probably seen his name dragged through the mud. He's been accused of lying to Congress and single-handedly rigging the stock market against retail investors to halt the GameStop short squeeze. But he's also the guy who built the most profitable hedge fund in history. Today, Citadel manages $67 billion, has compounded at 19% over its 35-year history, and has returned $90 billion to investors, the most of any hedge fund ever. So, who is Ken Griffin really? Is he a villain who got rich screwing over the little guy? Or is he the most underrated builder in modern finance? That's what this video is all about. This is the story of Citadel, the most hated hedge fund in history. Now, you've probably heard of Citadel, but you probably don't know that the firm almost completely collapsed twice, and in November 2008 was on a published list of the 5 hedge funds most likely to go bankrupt and was losing hundreds of millions of dollars every week. 18 years later to present day, Citadel now processes 1 in every 4 retail stock trades made in America. Ken Griffin's goal from day one was to build the best independent trading firm in the world, and we'll discuss exactly how he did that in today's video. It's a story that involves a satellite dish hanging outside a Harvard dorm room, hedge funds going from billions to zero, the US Constitution, and of course, Wall Street bets, Roaring Kitty, and GameStop. And what you'll learn is that to succeed in the hedge fund business, you don't always have to be right, but you do have to be right at the right times.
So the wonderful history of Citadel is how we're the most profitable hedge fund of all time. The chapter of how we were on the verge of going out of business in 2008 is now like a footnote in that book.
Now, before getting started, if like me, you're fascinated by the world of investing, you may want to check out the Applied Value Investing Certificate program being offered by Wall Street Prep and Wharton, where I got my MBA. This program teaches you how to apply the principles of value investing with the sophistication of an institutional investor, and it's taught by Wharton professors and keynote speakers from real investors, including Oaktree's founder Howard Marks, who is one of the most famous investors in the world. Through this 8-week-long program, you'll learn about the core concepts behind value investing, such as market efficiency, intrinsic value, process-driven value investing, and a whole lot more. And you'll also gain access to an exclusive global network with access to special in-person networking events. And so whether you're an individual investor or a student trying to break into a hedge fund, this program will give you the fundamental knowledge you need to invest like the father of value investing, Warren Buffett. And if any of this is of interest to you, be sure to use my code rareliquid to get up to $500 off. And I'll leave information and links for everything just discussed in this video's description. All right, now going into the story of Citadel, it starts with Ken Griffin, who was born on October 15th, 1968 in Daytona Beach, Florida, and Griffin was actually pretty cracked heading into college. In high school, he was the president of the math club, and he ran a company distributing educational software called EdCom. He did this out of his bedroom, and he sold it before he even turned 18 years old, so it's clear he always had the entrepreneurial bug. After applying to 13 colleges, Griffin goes to Harvard, and there he begins his investing journey. In 1986, Griffin reads a Forbes article arguing that shares of the home shopping network were overpriced. So he bought put options, which is a bet that the stock will go down, which it did. And he casually walked away with a profit of $5,000, which in today's money is about $15,000. That first win got him hooked, and Griffin started spending hundreds of hours at the Harvard Business School library, devouring any books he could find on finance theory. And in the appendix of the S&P's stock guide, he discovers convertible bonds and saw a discrepancy between stock and convert prices, which he felt he could exploit. And so he calls First Boston, and as an 18-year-old kid, walks into the regional office and grills an institutional salesman who says that convertible bonds aren't a strategy that they recommend to clients, but is something the bank trades on for its own account. This intrigues Griffin, who starts building his own pricing models and discusses them with his broker friend in Florida during his summer before sophomore year. And during this convo, a retiree named Saul Galkin listens in and after 20 minutes says, "I've got to run to lunch, I'm in for 50. Griffin didn't know it at the time, but he had just raised $50,000 and raises a total of $265,000, which is roughly $770,000 in today's dollars. And he does this from friends and family to launch his first fund called Convertible Hedge Fund Number 1 at the age of just 19. Then during his sophomore year in October 1987, Griffin gets right to work. He convinces Harvard to allow him to install a satellite dish on the roof of his dorm so he could receive real-time stock quotes, which at that time was a huge competitive advantage. And then just days later came October 19th, 1987, Black Monday, when the Dow dropped 22.6% in a single day, the largest single day percentage decline in US market history. Now at this point, you might expect that Griffin was like other famous investors like Bill Ackman, who learned investing lessons early on the hard way through losses, but that's not the story here. While most of Wall Street was obliterated, Griffin was actually shorting the markets and profited from the crash, allowing him to launch convertible hedge fund number 2 in 1988, which meant managing $1 million before he turned 20 years old. In 1989, Griffin graduates a year early from Harvard, and his track record leads him to an introduction to Frank Mayer, a hedge fund pioneer who ran Glenwood in Chicago. Griffin trades a convertible ARB strategy as a separate $1 million account for Glenwood and generates an impressive 70% return, which encourages Mayer to introduce Griffin to Glenwood's LP investors. In September 1991, just before turning 23, Griffin is able to raise $18 million, or about $45 million today, and officially launches Citadel, though at the start it was called Wellington Partners. Griffin launches his 5-person fund trading only US convertibles and Japanese convertibles and warrants, which were extremely inefficient markets in the early 90s, and Griffin used computer models to earn a 43% return in 91 and a 40% return in 92. The young grasshopper was becoming the master, but even though the protege was dominating and loved by his investors, he wasn't even loved by his own employees.
One of my colleagues said that he was my partner for years. We worked together for 30 years. And he said, let me tell you what it was like to work with you every day. Go get into a roller coaster and go as fast as you can. And then when you least expect it, you stop and change direction. And what's happening is we're going as fast as we can in the direction in which we think we need to travel. And he goes, and there's many times you snap my neck when you would decide, and rightfully so, that we were going in the wrong direction.
While the fund was generating massive returns, Citadel earned the nickname Chicago's revolving door for its high turnover rate, and this kind of culture stemmed from Griffin's admiration for Jack Welch, who was known for cutting the bottom 10% of his workforce every year. Now back then, Griffin was a difficult and abrasive manager who was impatient with small mistakes. He challenged traders to defend every nuance of their positions and grilled them during meetings. One former employee said he was a micromanager. He would dig, he was always challenging people to do things better. Now, something tells me that if we were in a private room, that employee would probably say that he was just a huge dick. But honestly, I might not be super nice either if I was managing 60 employees and $200 million at the age of 25, which is exactly what Griffin was doing in 1994. Sometimes I have trouble figuring out what to eat for dinner tomorrow, so I can't imagine what Griffin was going through at such a young age. 1994 would also be one of the worst years for Citadel. The Federal Reserve hiked interest rates 6 times, causing the bond market to collapse. David Askin's Granite funds blew up, losing $400 million, and Citadel's clients went into panic mode, pulling roughly a third of their capital and resulting in the fund's one of only 2 ever down years of negative 4.3%. Now, look, you see regards blowing up their portfolios on Wall Street bets all the time, so 4% may seem like nothing, but to an overachieving eager beaver like Griffin, he thought losing money in that sort of market was criminal. Griffin felt he didn't lose money that year because of bad investments. He was losing money because he was being forced to liquidate his positions because investors wanted their capital, which took away from his ability to navigate the markets. This became an extremely important lesson for Griffin. He named Citadel because he wanted it to be a fortress, but he couldn't do that with a one-trick pony convertible ARB strategy and with flaky investors. Mayer had once given Griffin advice not just to build a single strategy fund, but to build a platform, and Griffin would take that advice further than Mayer had ever imagined. From 1995 to 2007, Citadel would post positive returns for 12 years straight, and let's talk about how Griffin did that. Griffin's working philosophy came from the lessons in 1994 that if you're Avis and the lights suddenly go off at Hertz, you had better be in a position to make a lot of money. Translation is when other hedge funds collapse, you need stable capital to buy the cheap assets that are being sold at a discount. And so starting in 1995, Griffin taps into his entrepreneurial side to not just build a hedge fund, but a scalable business, and he does this with 3 moves. First, Griffin began treating Citadel as a system rather than a collection of smart people. He does something extremely unusual for hedge funds at the time by hiring consultants from Anderson Consulting and Boston Consulting Group to break down every single element of Citadel's investing process, from information gathering to trade execution into computerized flowcharts. Every step of every strategy was documented, auditable, and improvable, and the firm even built a natural language processor to scan broker emails automatically for bond quotes and then surface them to traders instantly, which seems easy today with AI, but try doing that back in the 1990s with dial-up internet. And then in 1998, he hires John DiRocco from rival fund Paloma Securities to build Citadel's own in-house securities lending operation, which allows the firm to borrow stock directly from large institutions like Vanguard and allows Citadel to fly below Wall Street's radar on sensitive short sales. Griffin's second move was to restructure Citadel's investor terms toward more permanent capital based on his lessons learned in 1994. And so in 1998, he gave investors a choice: commit to a minimum 2-year lockup or keep quarterly liquidity, but pay a penalty for early withdrawals. It was a tough sell and some investors walked, but most remained, and it couldn't have come at a better time because literally weeks afterwards, Long-Term Capital Management, or LTCM, a hedge fund run by Nobel Prize winners, had been running 25-to-1 leverage on $125 billion in assets and imploded, triggering a systematic deleveraging that forced funds to dump their positions at distressed prices. Thanks to its locked-up capital base, Citadel could be a buyer and ended the year up 30% and crossed $2 billion in AUM after just 8 years from founding. And by the way, remember LTCM because we're going to talk about them later in the video. Griffin's third move was diversification. Between 1999 and 2002, Griffin launched 4 new strategy verticals in rapid succession. Fixed income and macro in 1999, targeting interest rates, currencies, and sovereign bonds. Global equities in 2001, right after the dot-com crash, which made both equity investments and talent cheap and available. Citadel Securities in 2002 to take advantage of the shift to electronic trading, which eventually becomes a $22 billion business. And then commodities trading also in 2002, which is launched because Enron famously collapses, and Griffin immediately recruited Enron's energy traders and quant researchers.
The day they filed for bankruptcy, I chartered a Gulfstream jet, put 16 people on the Houston, and all we did was interview people at Enron for several days. What worked, what didn't work, how they made money, how they ran the business, what the competitive advantages were. Now, the great part about this story, I hired the entire leadership of the quantitative research effort at Enron.
Coupling strong returns and new strategies, Citadel's AUM triples to $6 billion in 2001, and Hal Lux's boy wonder profile puts Griffin on the map, stating, "Ken Griffin has built one of the world's biggest and most successful hedge funds while amassing one of the financial world's great fortunes. Imagine what he'll do when he turns 33. The Wellington Fund's 10-year net annual return was 30%, and as the youngest person on the Forbes 400 with a net worth of $650 million, Griffin was riding high, and while he had an incredible ability to profit when markets came crashing down, even Griffin wasn't prepared for the Great Recession in 2008, which would make the mighty Citadel Fortress look like mere toothpicks in a fire pit. Like Michael Jordan's fadeaway jumper, Citadel's signature movie was easy to see. When other funds blow up, buy the wreckage. In 2006, a $9.5 billion hedge fund, Amaranth Advisors, loses $6 billion on concentrated natural gas trades in a single month, the greatest single trading loss in history at the time. Of course, Citadel buys Amaranth's position at a steep discount and eventually turns a substantial profit. In 2007, a $3 billion fund, Sowood Capital, implodes with losses of 50%, and Citadel steps in buying its credit portfolios at distressed prices and profits handsomely yet again. To note, Griffin personally stopped trading in 2005, saying his staff was better than he was, officially marking his transition from best trader in the room to the best CEO of a trading institution, because by the end of 2007, Citadel would hit its peak AUM at the time of $21 billion, with 1,200 employees and net annualized returns of 28% since its founding, soundly beating the market's 11.4%. But Citadel would literally nearly die the following year. Lehman Brothers collapses in 2008, and the convertible bond market, which was typically half of Citadel's trading profits historically, got crushed, with Citadel's 7-to-1 leverage accelerating the pain. In addition, Citadel's $2.5 billion investment in 2007 into E-Trade's subprime mortgages and debt securities got nearly wiped out. Liquid positions got marked down brutally, and Citadel's fortress of supposedly uncorrelated positions began all moving together as worldwide market panic ensued. In October 2008, Citadel fell 22%, and in November, another 14%, totaling to a loss of an incredible 55%, amounting to $9 billion in losses. In his own words, Griffin said, "We were losing hundreds of millions of dollars a week, if not more." CNBC parked a van in front of Citadel, waiting to break the story of our demise. During this time, Lloyd Blankfein was the CEO of Goldman Sachs, and if anyone had an honest read on when this would end, it would be him. Griffin called him and asked for advice, and Blankfein answered saying that a forest fire ends when there's nothing left to burn. And so for a guy whose only down year was 4% in nearly 20 years, can you even imagine what losing 55% and $9 billion must have felt like for Griffin? This is why hedge funds are not for the weak. In order to survive, Griffin and his partners injected $500 million of their own capital to stabilize operations. Citadel exits non-core strategies that require leverage, and the firm puts up the gates, meaning it suspends all investors' redemptions for 12 months, which Griffin called one of the most difficult decisions he ever had to make. Imagine for a second in 2008 when markets are crashing. You're an asset manager who's invested hundreds of millions of dollars into a hedge fund, and you're told that you can't take your money out for a year. I'm pretty sure Griffin got some nasty phone calls. And remember when I told you that we'd talk about long-term capital management again, the Nobel laureate hedge fund that blew up in 1998? The homework Griffin did on LTCM is what actually saved Citadel during the Great Recession. While Griffin did receive $1.5 billion in redemption requests, that amount could have been many multiples of that if he didn't have terms that locked up the majority of investor capital. And this clause in the terms was exactly designed to prevent Citadel from being a forced seller. But no matter how you look at it, Griffin could do nothing but wait for the entire forest to burn so that he could eventually plant the seeds for a slow but steady comeback. Thanks to the locked up capital and gates to deny investor redemptions, Citadel was able to invest into assets at deeply discounted prices to mount a 62% comeback in 2009, which was impressive given so many funds went to zero. But if you have $100 and it falls by 55%, you're at $45. You actually need to get a 122% return just to break even. A 62% gain from 45 gets you to 73. So in 2009, Citadel was still well below its 2007 highs. And the way hedge funds work is that they typically can't charge performance fees until investors fully recover above their previous peak value. And this is known as the high water mark. After a mediocre 11% return in 2010, 20% in 2011, and 25% in 2012, Citadel finally crossed its high water mark for its pre-2008 investors on January 17, 2012, meaning it took a little more than 3 years of grinding just to break back to even. But before you feel bad for Griffin, he was still able to earn $900 million in 2009 due to management fees, his personal investments in the funds, and from profits generated from Citadel as a business, such as market making. Also to note, during this time, Griffin tried something and surprisingly completely failed. After banks were destroyed in 2008, Griffin attempted the same playbook of launching new businesses after a crisis, like after the dot-com bubble and Enron's collapse. He launched an investment bank to fill the void left by Lehman Brothers and Bear Stearns to make Citadel a multi-line financial institution, and hired senior bankers from Merrill Lynch to run it, but 3 years later in August 2011 abandoned the idea and sold it to Wells Fargo. Besides that one blip, Citadel was back. And starting in 2013, Griffin's legacy would compound just like his funds. The firm's AUM balloons from $16 billion to $26 billion in 2014, going beyond its pre-2008 size. All by the way, while Griffin is going through a dramatic public divorce in which his wife demanded $1 million per month in expenses, including $160,000 a month for hotels and $2,000 a month for stationery. The next few years go so well that in 2018, Citadel's AUM reaches $30 billion, and Griffin starts returning excess profits to investors and being extremely selective on taking on any new investors. He also becomes a much larger public figure as he tries to figure out what to do with all his money. He makes huge political donations and goes on a real estate shopping spree, spending $238 million on a 24,000 square foot New York penthouse, $122 million on a London mansion, and $59 million on a Chicago condo, all of which are records at the time. Citadel also has one of its best years ever during the pandemic in 2020. When COVID hit, Griffin leased the entire Four Seasons in Palm Beach and moved hundreds of employees there to create a finance version of the NBA bubble, and Citadel's Wellington Fund returned 24%, its best in 8 years. Griffin also helps evacuate 800 Americans from Wuhan, works with US officials on Operation Warp Speed, and donates millions to fund vaccine efforts. But despite all these great deeds, he would become one of the most deeply hated men on earth in a little subreddit you may have heard of called Wall Street Bets due to a stonk called GameStop. Now, before I begin, I want to be clear that this video is not about GameStop, but I do need to provide some context so you can make up your mind on whether or not Griffin and Citadel deserves the hate they get or not. It all starts in January 2021 when a 34-year-old Keith Gill, better known on Reddit as Deep Value and on YouTube as Roaring Kitty, turned a $53,000 bet on GameStop into $50 million. Roaring Kitty had been posting bullish due diligence on GameStop since mid-2020, arguing it was undervalued and ridiculously overshorted. And by January 2021, GameStop's short interest hit 140% of its public float, meaning hedge funds had collectively shorted more shares than actually existed. The biggest of these shorts was Melvin Capital, a fund managing $12.5 billion, and Wall Street Bets retail investors, who are typically uncoordinated and taken advantage of by professional investors, saw this as an opportunity to, for once, crush the hedge funds. Their plan was to do this through a short squeeze, which is when a heavily shorted stock rises dramatically, forcing short sellers to buy back shares to cover losses. This surge in buying demand creates a self-reinforcing cycle, driving the price up further and triggering more panic-driven buying from other short sellers looking to exit. That is exactly what happens, and I remember seeing it all unfold live. GameStop exploded from $17 on January 4th to over $500 on January 28th, and Melvin lost 53% in a single month. Now, where Wall Street Bets investors get angry is that while GameStop was literally headed to the moon, Robinhood, which is where nearly all retail trading was happening, restricted buying on GameStop, creating an insane amount of fear and sell pressure, causing GameStop to lose 60% and Reddit to lose its mind. And this is where the hate for Citadel comes in. For one, Citadel had injected $2 billion to bail out Melvin Capital. And for two, Citadel Securities accounted for roughly 40% of Robinhood's revenue from a practice called payment for order flow, where Robinhood sold its customer trades to Citadel Securities in exchange for a fee on every transaction. And so you can see why this is so suspicious. Citadel just bails out a fund that's at the center of being short squeezed into oblivion, and Robinhood kills GameStop's momentum by restricting trading and killing the short squeeze. On February 18th, the House Financial Services Committee summons Griffin, Robinhood's CEO, Reddit's CEO, and Roaring Kitty himself into a hearing, during which Roaring Kitty in his basement says his now legendary lines,
that I've been right about the company. A few things I am not. I am not a cat. I am not an institutional investor, nor am I a hedge fund. I do not have clients. I support the right of individuals to send a message based on how they invest. As for me, I like the stock.
Griffin, on the other hand, says the line that would haunt him forever.
I want to be perfectly clear. We had no role in Robinhood's decision to limit trading in GameStop or any of the other meme stocks.
Despite Griffin's claim, it would later be revealed that Robinhood's C-suite had been having suspicious conversations with Citadel. Robinhood's COO says that they were having a call about Citadel's demands on limiting payment for order flow, which can be interpreted as threatening to pull revenue and destroying Robinhood. Robinhood's CEO says he's going to talk to Griffin, while Robinhood's COO says Citadel is a total mess, and all this sparks the hashtag #KenGriffinLied, and Griffin to this day is still deeply hated by millions of retail investors. Now, with all this said, multiple class action lawsuits were dismissed against Citadel, and Robinhood has stated that its actual reason for halting trades was way more boring. The National Securities Clearing Corporation hit them with a $3 billion overnight deposit requirement that they couldn't cover, so they restricted buying to reduce their collateral obligation. For GameStop, the rabbit hole runs deep, so I'll stop here, and I'm sure someone in the comments will provide an even more thorough breakdown. If it was any consolation though, Melvin Capital never recovered and shut down with $6.8 billion in losses, and down with it went Griffin's reputation to all Main Street investors. So, after GameStop, how did Citadel proceed? Honestly, the firm hasn't skipped a beat. Despite everything happening with GameStop, the Wellington Fund returns 26% in 2021 and 38% in 2022, which is the largest single-year hedge fund profit in dollar terms ever recorded. $16 billion are returned to investors, and Bridgewater is overtaken by Citadel as the most profitable hedge fund in history. Since then, Citadel's performance has been solid in the low to high teens, and AUM has ballooned to an incredible $67 billion, almost doubling since 2021, and Citadel Securities now handles roughly 25% of all US equity trades, making it an incredibly lucrative business itself. Griffin still owns 85% of the firm, has a net worth of about $50 billion, and seems to have so much money he continues to either donate it like the $500 million he's given to Harvard, buys things like a $43 million original copy of the Constitution, spends hundreds of millions in art pieces, and also in record-breaking expensive properties, or he uses it to wield political and social power. Similar to Bill Ackman, he condemned the 30 student groups critical of Israel after the Hamas attack, which causes him to suspend Harvard donations, saying elite schools produce whiny snowflakes, producing one of the most public donor breakups in history, and he's also publicly feuding against New York City's mayor for his movement on taxing the richest of the rich.
What really upset me about the video was the fact that he put me in harm's way.
All this said, love him or hate him, you can't deny the results Griffin has been able to produce. Since Wellington launched in 1990, Citadel's flagship fund has returned 19% annually net of fees, one of the best long-term records in the history of asset management. If you invested $1,000 at the inception of the fund, it would be worth $328,000 today versus just $22,000 in the S&P 500. The way he was able to do this, especially at enormous scale when it's much harder to generate alpha, is not by being the smartest person in the room, but by building the room itself so that you're always the best informed one in it, and then pouncing on opportunities with lightning speed when the stars align.
If you're the smartest person in the room by far, you're in the wrong room. Like, you need to find a different room to get to.
From the satellite dish providing real-time quotes in 1987, to the commodities trading business he set up immediately after Enron's collapse, to the investor lockup terms set up in 1998 that saved Citadel in 2008, Griffin's story is not about knowing exactly what will happen next, but structurally positioning yourself to take advantage of opportunities when others can't, because the worst position you can ever be in is that of being a forced seller. Alright, so that's the story of Citadel. Hope you enjoyed. And if by chance you're watching this video because you're interested in breaking into hedge funds, you'll likely first need to break into banking. And if that's you, I have two great free resources for you. One is a 15-part email newsletter with all my best advice from leading JP Morgan recruiting. And another is a quiz I built powered by AI that you can take to see your chances of breaking into banking. I'll leave links to both in the description. Thanks as always for watching. And if you want more, check out my last video on the loudest investor on Wall Street, Bill Ackman.